Equities negative here. Good morning to you. We're down 1.3% on the S&P 500. On the Nasdaq, we're down by a similar amount. We're down by 1.4 on the Russell. The small caps even lower by 1.65%. That's the equity picture. It's a negative one. It's session lows going into the opening bell from New York City this morning. Good morning. There is your opening bell. Let's talk about things cross-asset. Let's talk about this bond market. 5 straight days of yields lower. We're down 281.27 on a 10-year this morning. The difference between 2s and 10s, just a single basis point. The euro is where a ton of pain is. 102.65. You've got to take the chart back to 2002 to see these kinds of levels. 102.67 and negative 1.5%. WTI crude 104.25. We're negative 3.9%. That is a turnaround in the last couple of hours or so. But the bond market for me is the main event outside of foreign exchange. In the bond market, we're seeing the spread between 2s and 10s get narrower, the curve get flatter, and we're seeing the bond market respond to weak economic data. Yields lower for 5 straight sessions. On 10s at 281, on 2s at 280, and we'll have a big conversation about what's happening in the credit market outside of Treasuries a little bit later this morning with Peter Chi of Academy, and what that will or will not mean for this Federal Reserve. At the open, about a minute in, let's get you some movers. We can do that this morning with Katie Greifeld.
It's another ugly day for tech already, and particularly for the chip stocks. Micron was the big loser on Friday. Today, it's AMD falling over 2% from the opening bell. JP Morgan also under pressure. John, I know you're watching that yield curve. Like you said, the 2s-10 spread just about 1 basis point away from inversion. That's bad news for the banks, bad news for JP Morgan, down over 3%. Travel stocks, no picnic either. You can see Carnival down 5.5% after just a terrible week last week, falling again today, along with just about everything else in the sector. Cowen, though, it's your rare bright spot, up over 16% after that late Friday news that TD reportedly exploring a takeover. Analysts this morning broadly positive on that potential merger in commentary. And John, I do want to quickly hit on Ford, because this headline crossed at 9:15 that Ford U.S. sales were up 31.5% year over year in June. And we know that Ford is betting big on EV pickups in particular. GM and Tesla not expected to compete in that space before 2023. That gives Ford a little bit of time to grab a foothold there. Currently, EVs make up just 2% of Ford's sales, but John, that's expected to be 40% of sales by 2030.
That stock is down about 4%. Katie, thank you. Good to see you, that's for sure. Euro dollar, not good to see this. That chart just breaking down even more, down 1.5%, 102.63. Nomura and Jordan Rochester earlier this morning publishing this. Today's move lower in euro dollar, thanks to Norway's gas strikes, new highs in German electricity prices, is just a warning as to what might materialize. Their numbers they're looking for now, 98 on euro dollar, 98 and maybe even 95. Right now 102.66, and numbers we haven't seen since 2002. That's the FX story. Looking ahead to earnings just next week, July 14th, you'll hear from JP Morgan. Before that, here's a data point for you. CPI next week on July 13th. Before we get there, we need to deal with payrolls this Friday. A lot to think about, Taylor Riggs, a lot to think about through the next couple of weeks.
And how much does that fold into the dollar strength story that you just mentioned, right? Sort of the defensive nature of this rally, and that really sort of is highlighted here when we take a look at cyclicals versus defensive and how sort of classic this chart is. With cyclicals, you're still down 26% when you think about where we are year to date, just over 6 months into the year. The defensives only off maybe about 4% or so. Earlier coming into this morning, that number was less than 3%. So it's an underperformer, but on a relative basis, it's still outperformer, if you will, when you think about the defensiveness of this. The next chart is a classic Dan Curtis chart. We're doing standard deviations, John, at 9:33 in the morning. On a standard deviation in terms of upside surprise, the household sector, the consumer, actually better than expected. Down at the bottom, housing, worse than expected when you think about where we are relative to consensus coming into this year. And if you change up the board again, you really see this. How much of this has been a rate story? Of course, today yields lower on a risk-off trade, but year to date, we're looking at mortgage rates rising, new home sales rolling over. But how much of this is exactly what the Federal Reserve wants to see in terms of making maybe the consumer feel less likely to buy, slowing down the overheated housing market?
Taylor Riggs, thank you. We'll catch up with Taylor again in just a moment. And Taylor hit the nail on the head. This is what Mike Schumacher of Wells Fargo said last week. This is a feature, not a bug for this Federal Reserve. This is the goal, the objective. At what point, where is the tipping point in this market where it becomes a bug and not a feature? Seemingly not now, with high yield credit spreads at around about 580. Is it 600, 650? Is it about the price? Is it about supply? Is it about liquidity? I guess if we carry on pushing it, we'll find out. About 4 or 5 minutes into the session, we're negative 1.7% on the S&P. Every single industry group on my screen right now is negative. Energy's down 3 percentage points. Materials down 3%. Katie did a great job of bringing up JP Morgan. Financials down by more than 2%. Staples down 0.4. The overall benchmark, the S&P, down 1.7. Taylor mentioned some of the house builders. The home builders year to date on the S&P down 33%. And Peter Cheer of Academy is sounding the alarm on housing. He says the following: I'm told that housing formation supports home prices. Scarcity remains an issue. All cash buyers make up more of the market, and all sorts of other reasons why housing prices cannot go down. But I see the combination of rapid price acceleration and the gap higher in financing costs as a toxic mix. Pete, I'm pleased to say, joined us right now. So Pete, let's start there. How big a problem do you see?
I see actually a very big problem. I think we really have to start thinking about the wealth effect, right? We're not hearing much talk about wealth effect, but if you look at this year, stocks have been horrible, bonds have been horrible, crypto's been horrible, and I think we've seen a turn in housing. And I just think that is going to accelerate the problems, and that we are so leveraged as a financial system to rates that people are underestimating this mix of, how each thing interacts with each other. And I expect a really horrible summer in terms of the data deteriorating far faster than people expect.
Let's put some numbers on that horrible data that you forecast, Pete. You know the consensus now, if we get a recession, it'll be short, it'll be shallow. Are you pushing back against that?
Yes, I think it'll be deeper and longer. Again, until the Fed really switches and gets off fighting inflation at all costs, I think they're missing all these little hints that there's problems in the economy, whether it's inventory builds, whether it's housing starting to slow down, and then the wealth destruction that you've seen in crypto and in terms of disruptive stocks is really twofold. One, it's hit the individuals who own those companies, were part of those companies, who were getting paid by those companies. But I think the next wave is the spending that was done by those companies. When people didn't care about cash flow positive, right? If you could just spend and it was all about potential future growth, there was a lot of excess spending being done by those companies. I think that's going to hit very quickly too. So I think we're in for a double whammy, and I keep having visions of Wile E. Coyote, with the Roadrunner just hitting a wall.
Pete, I wish it was that entertaining. Unfortunately, the picture you're painting is a pretty dreadful one and might be scary for some people. Typically, when we talk about the potential depth of a recession, we'd look for excess. You're speaking to that. We'd look for the breadth of that excess, and we'd be talking about leverage. Where is the leverage? How big is that leverage? Pete, that's why some people are pushing back and saying it'll be short, it'll be shallow, because this time around it's hard to find the excess on household balance sheets and corporate balance sheets. Do you push back against those 2 points too?
I do. I think we're not going to go into a great financial crisis. I think people's balance sheets are in much better shape, but we've become so used to this high level of spending, and we still haven't been able to separate how much of the spending that occurred was due to, government stimulus, right? We had so much government stimulus. You also have this issue that, okay, bank accounts are very flush, but a lot of people didn't pay their rent or their mortgage payments or their student loans. So I think there's a real balance, and I think things are more precarious. And if you dig deeper into the system, I think there's a lot of imbalances that are starting to come out. And we'll see that accelerate. Again, I'll go back to crypto, right? A few weeks ago, it was what price it is. Now it's about which companies are going out of business. Can you get your money out of accounts, right? So this narrative has changed, and it's changing very quickly. And I think we're just going to see that across the board.
Pete, why do you think that pocket of excess in crypto is sufficient enough to make a call that this could cause big problems in this economy?
And I just highlight this as maybe as the tip of the iceberg, but this time around, right, crypto's dropped 60 some odd percent, but to me, you've probably lost about $2 trillion. And that was relatively new wealth that was created. It was almost found money. So I think people were very happy to spend that money. That money was also, spread around various tech companies. Those tech companies have gone down. The people who had stock options in those tech companies, whether they were worth 5 million, 10 million, expecting to be 15, 20, 30 million, right? People were buying houses in cash because they didn't care. And now with this kind of across the board wealth destruction, people are turning about A, how do I preserve my wealth? B, will I still have my job? And that's a very different narrative. And I think you're just seeing spending change very dramatically, very quickly. And it's because now people have to go back and think about wealth preservation. I think that's for individuals and companies.
Pete, I wonder when this puts the brakes on the Fed's goals and how far they can take Fed funds. Take a listen to what Mark Cabana of Bank of America said this morning.
We we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop.
Pete, he made two big points here. One, we're only halfway through the tightening of financial conditions. And two, he thinks the economy is resilient enough that the Fed will have to take rates through 4%. Out of those 2 points, what do you agree with the most?
I guess on the economy, but I think we're not going to get anywhere close to 4% on hikes. I think long before November, the politicians are going to start realizing that a slower economy is far worse than any inflation pressure. I think the narrative out of DC is going to change. I think there's going to be political pressure, and everyone's going to talk about, wow, who cares about inflation if we start losing jobs, if spending starts going down, if GDP is decreasing, right? All you have to do is go back to Bush Sr. to see how important the economy is to get reelected. And I think that's going to be the narrative that shifts. And I think it's going to shift very rapidly. And they are going to regret their hikes, as early as August.
Is that the point that you want to buy this weakness? We're down 1.8% on the NASDAQ, down 1.9% on the S&P. You're seeing that classic race to the US dollar with euro dollar at 102.60. Is that the point at which you think some of this turns around, Pete?
Yeah, I would like to see maybe another 5 to 10% pullback. I'd really like to see some of these, high-flying ETFs like TQQQ, which is a triple leveraged QQQ, really see outflows. That to me would be the signal, okay, people have kind of given up and now is the time to step in and buy. I watched Eurodollar to maybe bottom. I like some of the calls that you were talking about earlier, whether it's 98, 95. And I think what's really happening is people are realizing Europe is in deep trouble. Europe is headed towards a recession. Once that gets priced in, then I think people start realizing, wow, how far behind is the U.S.? And that's when we start seeing a big reversal. That hopefully is kind of the washout that we need in U.S. equities to become a real buyer. Or we need some signal from the Fed that they are going to ease off on their both quantitative tightening and or rate hikes.
So, Pete, I just wonder, is it too early to see it in this earnings season if you're expecting some of this to really climax later in the summer?
I think it's probably too early to see in this earnings season, though I think you're going to start hearing a lot more about warnings, and you're going to hear about spending cuts. And it's the spending cuts that I think will be as important to triggering a wave of selling as it is going to be the earnings warnings.
Peter Schiff, Academy is going to be sticking with us. Some big calls here. He's looking for more downside in this equity market, maybe another 10%. I think if you are looking to buy this market, it makes sense for Pete to say, I want to see that before I buy. But ultimately, he's looking for some real economic weakness as a catalyst for some of that extra downside. Right now we're down 1.9% on the S&P. On the NASDAQ we're down 1.7. Talked a lot about this move in euro dollar. It's a real break, a break of numbers we haven't seen in a long time. To see a sub 103, you've got to go back to 2002. 102.67 and down by 1.5%. Heavily weighted, of course, a single currency on the dollar index. DXY 106.50, 106.50, and still the commodity market looking at numbers a little something like this right now. Brent and WTI north of 100, but only just as we break down there too, by 5.7% on Brent to 107, on WTI to 103, down about 5 percentage points on the day. Coming up, conflicting calls on crude emerging on Wall Street.
I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment.
That conversation up next.
we still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90, because of years of underinvestment. Nobody's actually able to raise production very much.
When it comes to forecasts, predicting crude prices is probably one of the difficult jobs out there, the most difficult jobs out there on Wall Street. The strategists right now all over the place. Citi on the one side, warning crude could collapse to 65 a barrel by the end of this year. JP Morgan came out with this scenario, seeing the potential, I stress potential, for prices to rise to an all-time high of 380 if Russia cuts output. Taylor Riggs has more. Hey, Taylor.
And that is the conundrum, John. I really wanted to focus on the downside call from Citigroup looking at 65 if there is a recession. It actually, and now maybe over $100 a barrel seems pretty far off, but you go out a few months, that is the December contract all the way back down now to just 91, 92 a barrel. So maybe not that far out when you're thinking if there is a recession by the end of the year. That is the call for 65 now, just about 92. A lot of this, of course, does bank on if there is a recession. We really have to do some historical analysis here. When you think about 08 and 09 and the global financial crisis, we went from 90 to 70. You bottomed out at 35. Don't get me started about 2020 with a huge demand issue. And then we saw some negative prices briefly there. But again, sort of settling out in that $30 range before really coming up here into sort of beginning of this year into back to the triple digits. I think what is so interesting when you think about where we are at about an average in the second quarter at 108 this year, price per gallon is $5. And John, this is the conundrum. Are higher prices the cure for higher prices? Do the consumers start to push back? How much of that is baked into this call as well?
Right now, Taylor, there are some big problems off the back of some of this in Europe, not just crude, but gas too. Taylor Riggs, thank you. And a big move in this German bond market, down 16, 17 basis points at the front end to 43 on 10s right now, down 13 to about 120. Do you remember when we got close to 180? It wasn't that long ago. Right now, 120 on a German 10-year. The economy minister out of Germany had this to say after putting together a bailout package for struggling energy companies. We will do everything to keep up the basic supply in the coming winter and to keep the energy markets running as long as possible. Matt, and it's good to have you back, mate. As always, Matt Miller, they are not the things you want to say as a politician, are they?
No, and especially not as a green politician, right? You don't want to encourage the use of fossil fuels, which Robert Habeck may have to do in order to get anything through politically. Now, the plan right now is to pass on higher costs. That should be a way to deter usage, right? But also this $9 billion bailout of Uniper, spending money at a time when the German government really doesn't want to have to do that. So we've got this issue at the same time as the euro comes down to below $1.03, right? We saw $1.02 this morning, the lowest level since 2002, which was really the very beginning of the usage of the euro in public by consumers. And at the same time, you've got a trade deficit for the first time since 1991. That's basically when the wall came down, like a year after the wall came down was the last time you had a trade deficit, because Germany typically builds and sells many more things than they buy. The problem is they sold 0.5% fewer things in the last month than they did in the same month the year before, and they bought 2.7% more things than they did last month in the same month a year ago. So they're seeing a higher trade deficit, they're importing inflation, and they have this lower currency that should theoretically allow them to sell more stuff, but they just can't do it, especially without chips, to get their all-important cars on the lots and out the door.
Matt, love this morning. Thanks for the extra shift on Bloomberg Surveillance. Thank you, mate. Matt Miller there, breaking things down out of Germany. Peter Cheer, I'm just going to keep it straight and open for you. What's developing in Europe right now, Pete, from your perspective? How bad is this going to be?
I think it's going to be very bad. I think you're seeing this energy crisis play out. I think you have a slowing economy. You have this displacement of people. You've got food crisis potentially there. So I think Europe's going to be very bad. I think you're seeing the U.S. going to follow suit. So again, it keeps coming back to me that there's this recession. And I do like the one other point someone made, I think, was we're looking at energy and where we stand in inflation. To me, there's three threads to pull. One is recession. What does that do to energy prices? What's that doing? Two is, have we really shifted to this kind of global commodity war? And I think that really is a global commodity war. I know we've discussed it before, where I think what you have is China and these autocratic, commodity-rich nations aligning to secure commodities. And that's left us out a little bit in the proverbial cold. And we're going to have to figure out what to do about that. And the third part of that thread, or the third thread really, is what are we going to do about energy domestically? I believe that we have to build out sustainable energy faster than we're doing. I also believe that we have to spend a lot of money and reinvest significantly in traditional energy. I really thought we would see some of this the day after Russia invaded Ukraine. And here we are, months and months later, and we're still not doing much. If anything, we're still causing friction between the energy companies and our need for production. I need to see a plan. I want to see DC come up with something that puts us on a 5 to 10 year plan towards energy independence. And then I can get more comfortable.
Pete, final one from me. High yield spreads breaking out pretty much all of last week, pushing 600 basis points in and around 580. You've talked to me about that tipping point in this economy. Before we get there, you'd imagine this market starts to pick up on it. How much wider do you think those spreads are going to go?
I think they can go a little bit wider. I really do think, though, this time it's going to be led much more by equity. So I think credit's going to outperform equities pretty significantly. Though for high yield, I'm always watching the Russell 2000. That's the correlation I look for there. On investment grade, I watch versus the S&P 500. I don't see the leverage in the system. I think you're going to see a little bit of weakness. You're seeing leverage loans. In fact, if anything, I'd probably be a little bit more concerned about leverage loans than the high yield bond market, because I think the high yield bond market over the last 10 years has matured. It's more, public in terms of the companies there, the information available, and a lot of the deals that might not have got done in the past kind of found their way into the loan market. So that's probably where I'd keep looking for that canary in the coal mine to see if you start seeing a breakout there.
Pete, thank you, sir. As always, Peter Cheer there of Academy. Just looking at this market at the moment, still breaking down. About 23 minutes into the session, we're down almost 2% on the S&P. We're down 1.6% on the Nasdaq. Looking at the bond market right now with a strong bid in Germany, down by more than 10 basis points right the way through the curve. 2s out to 10s. 10s right now in the US down 6 basis points. The 2s are down 2, and the difference between 2s and 10s is fewer than 1 basis point right now. 0.7 basis points. A lot to talk about, a lot to look ahead to. Your trading diary up next. 25 minutes into the session stateside after the long weekend. Welcome back. We're down by 2% on the S&P 500. On the NASDAQ, we're down by about 1.5. That's the equity picture. The bond market story, 5 straight days of Treasury gains, yields lower, down 6 basis points, 281.63. Risk aversion, a story out there. That's the headline. That's the price action. Here's your trading diary data in just a moment. Durable goods, factory orders, top of the hour. We'll get Fed minutes on Wednesday. The ISM, services, some PMIs, JOLTS, job openings, take your pick. Tons of data. Initial jobless claims, another round coming up on Thursday. Then the big one this Friday. The main event, it is payrolls Friday. And the median estimate so far is 273 in the Bloomberg survey. On my screen right now, 390, the previous number. From New York, this was The Open. This is Bloomberg TV.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into U.S. trading day. It's Tuesday, July 5th. Here are the top market stories we're following for you at this hour. A 20-year low. The euro weakened to a 20-year low against the U.S. dollar. Traders betting the ECB will slow down on raising interest rates as the economy risks being tipped into a recession. And eco data on deck. Factory orders, durable goods data, a slew of economic metrics to watch ahead of payrolls on Friday. We're going to break down what it all means for the economy. And fuel pressures. Natural gas soars while oil extends its range-bound run as Citigroup says crude could fall to $65 a barrel this year. JP Morgan, on the other hand, saying crude as high as $380. We're going to dive into that issue. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, I think it's that range that you're seeing even in the oil markets, in the stock market, even in the recession calls that's really moving a lot of the price action.
Absolutely. It's everything today, really, isn't it? Take a look at what's happening with crude. You're seeing a big downside move there. Take a look at what's happening with yields. They're coming down sharply. Equities under pressure. I'll tell you what's going up, though, and that is the economic data. Now, factory orders are a fairly bumpy series. Nevertheless, we have a upside bump to contend with right now. Factory orders coming through. The number, and this is a May number, up 1.6%. The prior number, 0.3. So a significant upside move, but it's still well within the normal kind of range that we've been operating in here. Ex-transportation, 1.7, so even better. We've got the durable goods numbers as well. These are final numbers. These are, again, May data that you need to be aware of. Coming through slightly better than anticipated at 0.8 versus 0.7 last time round. The transport number bang in line. The capital goods numbers as well, also a little better, but not substantially. But the data at the moment, it appears holding in there, which is in stark contrast to what we saw with the manufacturing ISM Friday. Now remember, we get the services data tomorrow, so pay attention to that. We also get jobs data that we're going to be paying attention to as well. Very much as Kriti laid out, though, we are seeing the story very much focused on the foreign exchange narrative today. But it's basically just an indication, I think, of what else is going on elsewhere. Kriti was talking about this being across the board. She's not wrong. It goes to our question of the day. What does the weak euro tell you about where you should be putting your money? Where does it say you should be investing your money? So let's try and answer that question and try and understand the signals that are being sent here. Christine Aquino joining us, Ira Jersey of Bloomberg Intelligence joining us. Christine, let me start with you first of all. 102 euro dollar. What signal does that send? What does it tell us about where we should bring money to work?
Well, guys, I think it's saying very negative things about Europe for sure. And so I would expect investors really having to rethink any sort of Europe bullish plays, particularly in the equity space that they started this year with. Remember, we started this year with the notion that this is finally going to be the year of European value. That clearly hasn't played out just because of the way that the general economic trajectory and sentiment has really gone in Europe. And now we're again seeing the ECB worrying increasingly about a potential growth slowdown, possibly even a recession, and that really cannot be great for any European assets. I think, part of the European story, you really have to ask, what is driving that currency weakness? Is it something that is fundamentally driven? Is it something that is central bank driven? I think in this case, it's a confluence of both, and it really does paint quite a negative picture for Europe in the second half for sure.
Ira, hop on in here exactly where Christine left off. The idea that is it fundamentally driven or is it central bank driven? And it kind of feels like the dollar story for a very long time was central bank driven. It was the Fed getting ahead of really a lot of these other G10 banks. To what extent is that still the story? And when do we start seeing it go back to the fundamentals of the actual U.S. or European economy?
Well, I think firstly the European economy is going to be very challenged over the near term. So certainly some of the move is fundamentally driven. But, as you noted, central banks have had a big part to play in the current move in the euro. And the fact that the Federal Reserve now, it looks like they're going to hike to 3.5%, somewhere in that range. The question is, will the ECB start to catch up, and how quickly will it do that? And Christine Lagarde last week did suggest that, hey, maybe 25 basis points and then 50 basis point hikes, so kind of starting to catch up. So there might be an interesting turn in the dollar-euro relationship in the not-too-distant future, thanks in large part to this shift in monetary policy expectations.
Ira, how do we know whether that's going to turn out to be the case? Because at the moment it feels like part of the story is the central bank divide. The ECB's late. But part of it is down to this unknown factor, which is Vladimir Putin and whether or not he's going to turn the gas on or turn the gas off or leave it on. We don't know the answer to that question. but I tell you, it is a huge one. And I don't understand the ECB reaction function in the second half of the year in that scenario. Say the gas does get turned off. Say energy prices go through the roof. Say unions say we need huge pay rises to compensate for us. How does the ECB react in that kind of scenario when growth is being slammed, but inflation is absolutely surging?
Yeah, you know, it's interesting, Guy. We actually just had a call this morning with the Bloomberg Intelligence strategy teams globally, and that was a big topic of discussion. You know, if the gas is turned off and we head toward the winter and you don't see any significant relief on the fuel side, then you'd have to think that real growth in Europe is going to slow substantially. Now, you know, there's one thing for the euro, but to your point, will the ECB be willing to continue to increase interest rates, amid the inflation scare? Now, I think that they will, and they will have to, in part because of their mandate, right? So the ECB does have a single mandate saying you have to get inflation under control. But one of the interesting aspects of this that we note at Bloomberg Intelligence is, look, demand side inflation in the U.S. is much stronger than it is in Europe. So because of that, you can wind up with a significant growth differential and maybe an increasing growth differential between the U.S. and even the U.K. and the rest of Europe because of what's going on in the Ukraine.
Christine, hop back in here and talk about that euro-dollar dynamic that Ira was just outlining here, because we're looking at, I'm trying to pull up this 102 on euro dollars right now, but I'm curious, if we hit parity, how much further could euro weakness go?
Well, Critty, I think we've moved on from the discussions of parity now in Europe. Just looking through some of the morning notes this morning, we're already seeing calls for euro-dollar to hit below parity at 95 euro cents versus the dollar. And so you can really get this sense now of just that decline, continuous decline in the euro that people are expecting. And of course, the flip side of that is this continued strength in the U.S. dollar. But I would also point out that that's not necessarily a good thing, particularly for U.S. corporates. A couple of months ago, we already heard from a bunch of blue chip companies really lamenting the strength of the U.S. dollar in a way that we've never really seen before. And so if this euro weakness, the flip side of that is continued dollar strength. You have to wonder when that's going to start becoming a problem for some of these U.S. companies as well, and when that's going to start eating into their profits, and whether people in the market, investors, will start kind of gleaning more fundamental implications from that beyond the corporate space.
Yeah, I think it's going to be fascinating to see what the earnings season looks like and how they do talk about that translation effect. Ira, the other factor here as well is just the growth narrative. If Europe craters as a result of the energy crisis economically, I'm assuming that will have ripple effects across the Atlantic. To Christine's point, there's a lot of US companies with a lot of business in Europe. It's a major part of the global economy. And if it goes into reverse in a big way, presumably that is going to have a significant effect not only on the US economy, but the way that the Fed thinks about it as well.
Well, certainly the Federal Reserve and every central bank globally is going to think about, hey, if Europe's in a recession, are we going to follow? But I do think there are significant differences between, obviously, the Eurozone and the UK and the US, just in terms of what are our trade flows, where do we, how does the overall economy react? And I do think in the US, we have to disconnect, and Gina Martin Adams, my colleague on the equity side, always brings this up. The stock market is not the economy, right? So if you do have large multinationals that are seeing their profits crimped a bit because of the exchange rate issue, that doesn't necessarily mean that the U.S. economy has to fall out of bed. And in fact, just the numbers this morning for May suggest that the business sector is still doing reasonably well. Factory orders up pretty healthy. You also had durable goods orders up reasonably well, good as well. So you wind up with maybe a dichotomy between what's going on in Europe because of the significant increase in fuel prices versus the U.S., where yes, prices are higher, but they're also we're also not as reliant on one source of and a foreign source of energy here directly. So I do think that you can have growth okay in the U.S. and still be shrinking pretty significantly in Europe.
Ira Jersey of Bloomberg Intelligence and Bloomberg's very own Christine Aquino. We thank you both, as always, for your insight. Coming up, more on the Euro's weakness, how to position your portfolio in the wake of some of these pretty drastic FX moves. Seema Shah, Chief Global Strategist at Principal Global Investors, joins us next. This is Bloomberg.
This week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
We're looking at an economy losing momentum faster than what we anticipated.
Economists have begun to cut their top-down economic forecasts for GDP.
This is a global story.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
We do expect the Fed to hike rates more aggressively.
The Fed has been driving the car looking through the rearview mirror.
The economy is slowing, and the Fed is saying that's collateral damage.
Companies and consumers need to get ready.
Frankly, we think they can keep going.
I don't think they blink. We did see some pretty notable downward revisions.
We expect more downgrades.
Those were Bloomberg TV guests weighing in on the U.S. recession outlook. Let's get back to our question of the day, because in addition to factoring in recession, you also have to factor what some of these weak euro signals are telling you. Where do you invest? Our question of the day asks just that. What does a weak euro signal about where to put your money? We're going to ask that question to Seema Shah, Chief Global Strategist at Principal Global Investors. Seema, thank you as always for joining us. We're looking at 102 on euro dollars. We just talked to Christina Aquino and Ira Jersey saying that perhaps that euro can weaker even further. Where do you put your money in that kind of environment?
Look, it's undoubtedly, it's a really tough global environment, not just for Europe, but I think particularly for Europe. And that's what the euro weakness is telling us, is that the European economy is in a considerably worse state than anywhere else in the globe. When it comes to investing, we are still US over Europe. We think that Europe will fundamentally underperform Europe as we go through the remainder of this year. But also, when you're thinking about the US and other countries, you have to start being cognizant of which countries, or which companies, I should say, have significant revenue exposure to Europe. And typically, those are your large cap. So that starts to build us a bit of a question. A lot of people talk about quality and stability, which you typically get in large cap, but you also have to be very, very aware of the exposure that they have to countries like the euro. And as a result, it's actually one of the reasons why we've moved out of this large cap and more into the mid cap space.
Any areas in particular in the mid caps that you're going to be watching? What's the best place within mid caps to insulate myself away from this risk? Because some of those mid caps will also be providing services up to large caps. They'll be part of a supply chain. Are there areas that you are seeing quite clearly as being insulated?
So, Guy, it's a really good question. I think everything that you've just pointed out there is exactly why. It's no longer just about taking more of a top-down view. This is an environment where you have to be a little bit more nuanced to understand what are your company exposures. And as you said, some of those mid caps will be supplying the large caps. Now, from a more fundamental basis, we look at mid-cap and we say, okay, look, that has got exposure to things more like energy and utilities, which will typically, at least in this environment, be a little bit more defensive. So we continue to like energy, but it is certainly a lot more of a significantly more challenging investment story than I think we've been associated with over the last 2 decades.
Seema, let's stick with that energy story, because that's been an inflation hedge to some extent. It's been the latest defensive play in the markets for almost a year now, and it's the trade that's worked. But I'm curious that if we are talking about recession, you kind of have perhaps some of these prices slightly suppressed because of that recession talk. I'm curious when that trade unwinds, because you're looking at it as an inflation hedge and suddenly you find out we're in the middle of a recession. Isn't that the first trade that collapses?
Well, typically, yes. And I think that recession story is inevitably going to be very challenging to the energy commodity space in the near term. But then, when we look at commodities, there is a structural shortage which should actually support prices beyond that near-term weakness. So actually, we continue to like commodities. We continue to like energy. The one concern for us on the energy side specifically is on the regulations. Which countries are going to be bringing in regulations which are going to pare back some of those potential profits for energy companies. So to us, that is the part that we need to watch closest.
There is the potential for energy prices to go sharply higher, though, Seema, here. We could see European gas prices going through the roof if Russia cuts the supply off. We could see energy prices more broadly going much, much higher. JP Morgan talking about $200-300 potentially on the price of Brent. In that kind of environment, all economies are going to suffer. Europe in particular, as we've already highlighted, is going to suffer probably more than most. What are the ripple effects, just economically, just from a macroeconomic point of view, that we need to be thinking about if Europe was to get cut off, see super high energy prices, and see basically an economic collapse, the kind of economic collapse that German unions are beginning to warn about?
I think you've just said it there. I mean, it's devastation for the European economy. I think, this is a tail risk. We're not forecasting this at the moment. But inevitably, this is the one, when we look at valuations, for example, for Europe, European valuations are very attractive. Why are we not overweight on that side, and why a lot of investors not overweight? It's because of that fundamental tail risk that is, it seems, looming larger and larger. So we have to be really familiar with this. Now, from a global perspective, we have a baseline view that the US is going to go into recession early next year. We think that the recession is going to be somewhat shallow. I know everyone's getting bored of this word, but it's a shallow recession, which is maybe a little bit more prolonged. Now, on the other hand, if you do have the point where oil prices rise to $150, $200 a barrel, well, this is your stagflationary scenario where you not only do you have a very prolonged recession, but you have a very, very deep recession. So I think this changes the narrative very significantly. And given that it is, I think the tail risk is a little bit higher percentage chance than what you typically associate with tail risk, it does mean that within portfolios you have to be very defensive.
Simo, we have about a minute here. I'm curious, when you say a very deep recession, what kind of historical precedent are we talking about? I mean, we've seen plenty of recessions from the 70s, from the arguably the late 80s as well, and even 2008. But I'm curious what actually applies here when we're talking about a deep recession, perhaps spurred on by this kind of inflation.
So this is your stagflation scenario. It's not the global financial crisis. That was a very, very different kind of beast in terms of the various imbalances that had built up over the time that had to be drawn down. This is more like your 1970s stagflationary effect. In some ways more concerning, but again, it's a slightly different picture. So there are some comparisons, and certainly from an investment perspective, it's something that we all need to be cognizant of as we're positioning. And as I said, that's one of the reasons that even if you do have hopes that the US can come out of this late in 2023, even potentially for Europe, there still has to be some defensive positioning within there. And again, that's actually one of the reasons that we still like real assets. This is still an inflation-led story. Even in your baseline, your downside scenario, this is where inflation is leading the way, and it's why real assets really outperform.
Seema, always great to catch up. Really enjoyed the analysis. Thank you very much indeed. Seema Shah, Chief Global Strategist at Principal Global Investors. Still ahead, the US Treasury Secretary and China's Vice Premier talking tariffs. The Biden administration may be about to roll back some of them and may increase others. Details to follow. This is Bloomberg.
This is Bloomberg.
We are getting some breaking news here, this time out of Germany. Germany may get up to a 25% stake in Uniper, that according to Handelsblatt. This, of course, is the German gas giant. We know that Germany has been looking for ways to kind of help that industry as well. We're looking at a potential bailout package of as much as 9 billion euros, $9.4 billion, if you want to look at it from that stand. And it's really not just the only one they're looking at. They're also perhaps looking at other ways that they can really help that industry. A lot of analysts saying right now that if Germany really falls because of this gas issue, that could mean the fall of the entirety of Europe. We're, of course, going to stick with that story and bring you any headlines related as we get there. But for now, let's go from Europe to China. China and the United States discussing Trump-era tariffs that President Biden is looking to ease. Chinese Vice Premier Li He told U.S. Treasury Secretary Janet Yellen in a video call that these tariffs are a source of concern. Bloomberg's Washington correspondent Anne-Marie Hordern has the details. Anne-Marie, we're looking at about 20% tariffs on both sides. What are the odds that these are actually decreased or even completely eliminated?
Well, we just don't know yet. For months, the administration has been debating this, and ultimately the decision will come from the president, who's been given a number of options on whether to lift those Trump-era tariffs or not. But the divide within the administration is very clear. You have last month Secretary Yellen, who also was on the phone with China's vice premier. She said last month that they want to reconfigure those tariffs. At the same time, you have Ambassador Tai saying that these tariffs offer her leverage. That is the word she used. And she said that any sort of impact on inflation will be marginal. And when you look at what Barclays is saying, they're saying about 0.3 of a percentage point potentially could be shaved off inflation. So what the president needs to do is decide whether or not, on one hand, remember we are going into the midterm elections, on one hand, the Republicans may use lifting those tariffs as a means to call the administration soft on China. On the other hand, the president has said he will do anything in his power to bring down inflation, because inflation is what the electorate is worried about, and that keeps showing up poll after poll after poll.
Anne-Marie, how targeted could this be? Could the president reduce tariffs on, say, back-to-school goods, but increase them elsewhere? Is this a zero-sum game, just playing with the levels on different areas that are currently experiencing these tariffs?
Well, Secretary Raimondo had said recently to CNN, it's consumer goods, things like bicycles. So if it's going to help the president, he would probably want it more help with more things like gasoline, with groceries, and these tariffs would not hit that. But potentially, if the administration were to lift some of these tariffs, it would be $1 billion of consumer goods. Then potentially there would be a probe into other subsidies in the Chinese economy. So it could be a more targeted approach to other issues they have with China, while at the same time lifting tariffs on consumer goods to try to help the everyday consumer. We should also note this won't be a light switch. This would take months to potentially drip down to the price consumers are paying when they check out for these goods.
Anne-Marie, we have about 30 seconds here. I'm curious how this balances out with some of the geopolitical tensions, specifically any sort of alliances that China and Russia have at the moment.
Well, Secretary of Treasury Janet Yellen had mentioned Russia in her call, as well as China's unfair market practices, and they said that it was candid. But we should also look forward to a meeting that we found out about this morning when Secretary Blinken goes to Indonesia to meet with his G20 counterparts. He will also be sitting down with the China Foreign Ministry. So this story is not ending here.
Anne-Marie, we will certainly keep a careful eye on it. Thank you very much indeed. Bloomberg's Anne-Marie Hordern joining us from the White House, back at the White House. Coming up, we got a better than expected number for US factory orders in May. Rowan Gandhi, what does it mean for his business? He's the CEO of GMM Non-Stick Coatings. I have to say, last time we spoke, fairly downbeat. Have things improved? This is Bloomberg.
We're about an hour into the U.S. trading day. Bloomberg's Katie Greifeld is tracking the moves. Katie, what do you see?
Well, we're already off by about 2% in the S&P 500 after Friday's big rally, and that shouldn't be any surprise because of the last 15 times that we saw the S&P 500 gain by 1% or more, 13 of those times were followed by a fall. Definitely seeing that today. No love for stocks, but a big bid into the dollar. If we look at the euro-dollar pair, that is the most actively traded currency pair. We are officially on parity watch. You can see the euro is at its weakest level to the dollar since 2002. That was a long time ago. And of the other big headlines that we had crossing the wire this morning, also taking a look at Ford. So we know that chip makers have been a huge problem for the automakers. Ford was actually a bit of a bright spot. You saw 2Q auto sales actually increase by 1.8%. You compare that to double-digit losses for some of its peers, but Ford shares getting no love today because this is a market that is obsessed with economic growth. There was a great note from Neil Dutt of Renaissance Macro this morning saying that this is a recession trade, and you can absolutely see that in the intraday price action. You can see that banks are down, you have energy down, you have chip makers down as well. Energy actually off by 4%, so not really a hint of risk appetite when you look at this board, Creedy.
Bloomberg's Katie Greifeld, thank you as always. From the markets to the economy, one of the big economic releases we're watching this week is Fed Minutes out tomorrow. Bloomberg's international economics and policy correspondent Michael McKee joins us right now. Mike, what should we be watching? Tell us everything.
Well, we're going to look for any hint about what the Fed was thinking. Now, remember, this is going to be 3-week-old data, what they were thinking about the possibility of recession at the time they met, and what they thought the possibility of inflation coming down would be, maybe what the mechanics of that are. There's not really much confusion about what the Fed wants to do and thinks it has to do. Jay Powell's been out and about speaking quite a bit. Other members of the Fed have been as well. But given the gloom hanging over Wall Street, there will be a lot of interest in anything they can glean out of what's in the minutes.
Is the expectation, is the risk here, Mike, that actually this set of minutes signals that the Fed is going to be even more hawkish than maybe we've been signaled to thus far? As you say, kind of post the last meeting, all of the narrative, we've heard it from Powell, we've heard it from everybody else, has been fairly hawkish. Well, is there a danger within these minutes that actually it's even more hawkish? Where does the risk lie, that they're more hawkish or more dovish?
I mean, you hate to say that Wall Street can misinterpret things, but they can. Yeah. And I suppose that the risk would be more hawkish, even though these are 3 weeks old and we've had more data since then, and we're going to get the jobs data on Friday. The two St. Louis guys, Chris Waller and Jim Bullard, who've been out front in saying the Fed needed to do more, are both speaking on the economy and monetary policy on Thursday. So a lot of different information could be coming into the markets that supersede the minutes. But if the minutes are seen as particularly hawkish, you're right, we may get an adverse reaction.
Mike, to what extent is the market ahead of the Fed, so to speak? It seemed like for a while it was kind of this game of who could be even more hawkish, the market or some of these members of the Federal Reserve. But I have to ask, does that dynamic still exist, given that we now have 75 basis points in the rearview mirror?
It seems to be easing up a little bit now that the Fed has sort of caught up. For a long time, the market was ahead of the Fed. The Fed didn't mind that. It sort of let people know what it was going to do over the longer term and let the markets find an equilibrium price. And the markets moved up to where the Fed basically is now. I mean, across the curve, we're above the Fed's version of neutral. The question is, what comes next? And the markets are already ahead of the Fed in that regard and deciding that maybe a recession comes next and the Fed's going to have to cut interest rates. That's farther down the road, but we do see the market already, if you look at the WIRP function on the Bloomberg, already paring back from 75 basis points in September to 50 now, and we'll see how the data treat it going forward.
What is a